I just wanted to jump on and have basically just a conversation with you because I remember last time we talked, you started asking questions and the way you articulated them was very good. And I know that it's a lot of questions that people are trying to ask and maybe they can't put the words together. And then add the next layer on top of that. You know what you're talking about. You know the right questions to ask because you have a successful business that you've built on your own. You have employees that you're running. You're making a good amount of money. And then you're asking the right questions of like, how do I take some of the risk off, right? I'm making this money and I don't want all my eggs in one basket because what happens if the basket, blows up on me, right?
Exactly. Yeah, man. Well, I'll say this. First of all, I've been just, I guess, learning so much from your emails, man. Your email newsletter has been super beneficial. Like the case studies that you put in there, like nobody's putting together an email that actually has case studies and raw, practical, actionable information. And not only is your LinkedIn like that, but the newsletters are like that, man. So first of all, thank you for that. And, I think the big thing, man, is like, business is one thing. We've gotten to a place where in 3 years, we've grown to 3 locations, solid team, still in the startup phase, but our 4th year anniversary is in 3 weeks. And so, we've gotten to a place where we positioned ourselves to scale at this point. But like you said, man, as much as I'm excited about doubling down and growing Holy Hill Media, I'm thinking about the future of my family as well and their financial security. And to put all my eggs in one basket, like you referred to, man, it's scary for me. So obviously when Gavin connected us, our mutual friend, we hopped on a call and you just seemed so down to earth and practical with how you explained everything. And so as I started, like, I got to follow this guy on LinkedIn, first of all. So got on LinkedIn and I'm seeing your posts and then you're starting to talk about things like leverage and long-term investments and what makes a good asset. And all of these conversations they cross paths with entrepreneurship, but investment and growing a small business are 2 very different things at the same time. So as much as I feel like I should know, I don't know. And so, I guess to give some context to my curiosity.
Yeah. That phrase that you said, there's a lot of things that are parallel in the world of investing and then in the world of being an operator, a business owner.
Yeah.
But they're not exactly, they're still very different, right? So like you can be a really good operator of a business, but not necessarily be on point when it comes to investing and vice versa. Like, you can be a really good investor, but not really know how to run a business. And I know the reason I agree with this so much is because literally when we were starting Rust Belt Capital a couple of years ago, we were in the same position. Like, how to do the investment stuff. You've made a lot of money investing, but now you have to put together a business with back-end infrastructure and systems and communication and marketing and how the heck do you market and how do you talk to people and how do you talk about your value proposition and all this type of stuff. And it's like, oh my gosh, dude, I just know investing, right?
It's exactly, man. And I think I wish more especially small business owners were having conversations like this, because when you talk about, one of the things like, you mentioned earlier, diversifying your income, being able to make your revenue just a little bit more safe. So all your eggs are in one basket. To be able to do that for one business, that can actually dilute the value of a company by trying to do too much inside one business. Yep. So when I'm looking for additional assets, I don't want it to have anything to do with Holy Hill Media. Mm-hmm. You know what I mean? I want it to be completely different, or in the sense, I'd need them to be in different accounts under different LLCs, completely separate from a structured point of view. And so like, if you don't mind, man, my question just out of curiosity is just, finding the good assets. It's a broad conversation. I know we can go real estate, private equity, stocks, all these things that you've already done, but I'm curious, when it comes to small business owners trying to diversify their income, and also considering the fact that small business owner, as you know, I don't have a ton of time to go and start another business. It's not what I'm trying to do. I want to get my money to move for me. And I'm not exactly sure how to do that. And then considering all the elements that you're referring to on LinkedIn, such as like leverage and time, and what does leverage actually mean? What does leverage mean in real estate? What does leverage mean in stock? It's all different. And so Pandora's box, man. Pandora's box.
Yeah. So to kind of answer some of what you're talking about, what we would say that at Rust Belt Capital, what we say, the framework that we use is good assets, leverage, and time.
Yeah.
That is how you find good investments. That's how you make money when it comes to investing. Now, most people are not capable of finding good assets, even if they go to a financial advisor, even if they go to Edward Jones or Charles Schwab or whoever else.
Yeah.
And if you're using the stock market solely and it comes to investing, specifically investing, you're certainly not using leverage. Okay. Because leverage is borrowed money.
Yeah.
Okay? There's good and bad to that. And we can get to that later. So the only part of that formula that you can use is time. So you're only using 1/3 of the entire arsenal at your disposal if you even know that this arsenal is at your disposal. And I didn't come up with this framework of good assets, leverage, and time. I ripped it off of Warren Buffett. Literally just go study the guy, watch how he built Berkshire Hathaway, and you start realizing good assets, leverage, and time. And so we can get to the good assets part about how I ripped this off of Warren Buffett.
Yeah.
So if you listen to the annual shareholders meeting of Berkshire Hathaway, which is a company that Warren Buffett put together, and you listen to parts when they get questions asked about diversification, Charlie Munger, who passed away recently, and Warren Buffett say diversification is a hedge against ignorance, or they don't like diversification. Now, why don't they like diversification? Because diversification basically means I don't know how to do the due diligence or the research to identify the best businesses in my town to put money in. Therefore, I'm going to go put a little bit of money in every single business I can get my hands on and hope that I'm putting money in the best businesses, but also knowing that I'm probably going to put some money in the bad businesses as well. And so at Rust Belt Capital, our entire idea is, why don't we just know how to do the due diligence, go and find the top 3rd businesses that are the best in our town or community, which is the Midwest, and just invest in the good businesses and not fiddle fight around with the bad businesses. Like that makes way more sense.
100%. Yeah.
It's easier said than done because you have to have the ability to understand income statements, like your income statement, your cash flow statement, your balance sheet. So you're kind of getting into very intense, like investment banking, private equity skill sets, right? And most people in Ohio do not have access to people who actually know how to do that very well.
It's a fact. Yeah.
So that's the whole good assets part. Our idea here is to make that available to people who work with us as clients. Is basically we're just trying to buy the top 3 businesses. They're very simple to understand and simple and easy to operate. Next comes the leverage part. Leverage is borrowing money, right? So in investing specifically. So the reason we want to borrow money is because our equity, our cash, typically can make more money or a higher return than what we can borrow money for. So for example, you used to be able to borrow money to buy a house at 4%. Now it's 6, 7, 8% now. Even with 8% interest, we can still grow our equity at about 15% or maybe even more. So if our equity to us, we say is worth 15% a year, wouldn't we want to use cheaper money to buy the same asset?
100%.
Yeah, because our returns start going higher. So that's the whole idea behind leverage in investing. And then the last part is time. Obviously, if you got a good asset, another thing that Warren Buffett would say, our favorite holding period is for forever. So we have to agree with that, right? And it's not just because we want to hold on for forever, but it's because the longer we hold on to an asset and the less trading that we have, the lower our risk is. Because there's costs when it comes to trading, whether you're trading in the stock market or whether you're trading in private businesses or whether you're trading in real estate. We have to pay brokers, we have to pay taxes, we have to pay all these different fees to do a transaction. We have to go market a deal. Okay, that's if we're selling, and vice versa if we're buying. And then we have to pay these fees to do the business. Also, you could make a mistake. And if we make a mistake, 100% gain followed by 100% gain followed by 100% loss is still zero.
Yeah.
We want to stay with that, right?
Yeah. So question for you then, because what I hear you saying is obviously upfront, the most valuable approach is understanding what a good asset is. Otherwise, time and leverage don't actually matter.
Correct.
And so understanding how to find and like thoroughly understand what a good asset looks like. Now, that makes sense.
Mm-hmm.
When you move on to leverage, though, that to me, I borrowed money, right? The cheaper the money, obviously, the greater the spread, which is fantastic. However, I do know that even borrowed money takes money down.
Yep.
So I guess my question for you is, how do you scale that then? Because if I'm leveraging money, say I have, let's just say, 50,000 for simple math, and I'm going to get some sort of, whether that's an SMB loan or whether that's, a loan to go purchase a apartment complex in Bowling Green.
Sure.
That to me, it's like, I'm limited to what that can do for me, that asset can do for me, that apartment complex, to be able to scale, because I only have the cash reserve that I'm putting away or the equity over time. But what I hear so many, especially real estate investors, talking about is doing 1 to 2 properties a year. And it's like, how do you do that without having $300,000, $500,000 cash flows? Like, how do you use leverage in a sense that's scalable versus, and maybe what, and maybe it's not as fast paced as as what I'm anticipating, but I guess, how is leverage if I'm still putting cash down?
Yep. Good question. So leverage doesn't remove the idea that you have to have a down payment or that you have to put some type of skin in the game. What it does is it just magnifies or intensifies the impact of your cash. So to kind of answer your question, how do you scale? This is why it's very important, especially if you're younger people, you're in your late 20s, 30s, or even 40s. When you're getting into investments, and especially real estate, focus on cash flowing real estate.
Okay.
It's going to take a little bit longer, but it's safer, right? I'm very risk averse, so I'd rather have a safer investment, but that's going to give you cash coming in. And the more you can come and put more value, pump value into the asset that you've bought down the road, you can then restructure that leverage. And you can realize the appreciation that you have without actually having to take off your position or selling the asset. And then you go and take that new capital that you got and put it into another deal. So for an example, we bought a 64 unit apartment complex 2 years ago. Every $25 that we increase rents adds roughly $250,000 to value of this property.
Amazing.
Today, we're up about $100 to $125 a door across the board, meaning we've increased the value of this property probably about $1 million.
Wow.
If we put $1 million down, so we could get all of our initial investment back today if we wanted to, and then take that money, defer the taxes on it, and go and invest it into another property. That's how
do you defer taxes on, because it's your equity, right? You own the equity.
Yep. So what we're doing is we're restructuring the debt. Okay. And so since we're restructuring the debt right now, say it's a couple $1 million, we can go get a couple $1 million plus one. And then technically we have a loan. We haven't actually realized anything yet. Therefore, we've deferred, using the IRS tax code, we've deferred our taxes on that until futures or until down the road.
Amazing. Which would be super helpful for somebody in small business, private equity.
Correct. Now, like I said, we try to do things very responsible. So yes, we could do that today. However, we're choosing not to do that and wait so that we can take the cash flow, the excess cash flow that we have off the property today, and keep investing into the quality of the asset before we do that. Because once we do that, obviously our cash flow gets compressed because our debt payments go up a little bit. And then we're obviously going to manage our risk of what is our risk by taking more leverage on this property versus our cash flow. So it's always about managing risk, not biting off more than you can chew. And before you go and restructure any debt on a property, I always think get the property as in good shape as you can. This reduces risk. If you ever have to sell the property, it's easier to market the property, and it's easier to fill the property with tenants.
Okay. And so that's essentially before you're going to get it refinanced to be able to have equity to pull from it. Is that what you're referring to?
Correct. Yep.
Okay.
Correct.
Okay. So I'm not sitting here with $1 million to be able to put down on a, 64 unit complex, but I do have cash set aside. And like I told you before, just a few weeks ago, I texted you, like, what does it look like to spread out, these cash flow avenues so that all my eggs aren't in one basket yet again. Now, I know that you can start anywhere. And I've heard this on a million self-proclaimed real estate experts on YouTube. You can start anywhere, right? With however much you have saved. But for a small business owner, young, I don't have kids. And, again, business is 4 years old. It's a profitable business. It's steadily growing. It's as safe as small business can be in the industry that we're in. But I guess I don't know when to pull the trigger, right? Like, when is a cash pile enough to move away? Like, we have an account that we're saving for. Obviously, we have our emergency fund. We have checkings. We have a primary and a secondary savings. Secondary savings is more for investments. Now, that's growing and growing and growing, but it's like, well, when do you pull the trigger? How do you know when to take that money, put that into, a good asset? Obviously, knowing that now I have to consider leverage and making that money actually a piece of, a leverage opportunity. But I don't know when to pull the trigger. I don't know should that be private equity? Should that be real estate? I know you're real estate heavy. I know that's something that you're really passionate about, but what would you recommend for somebody like me? And when should I do that? When should I move forward?
Yeah, no, that's a really good question. And actually, when I was younger in the game, it's the same question that I had is like, when do you pull the trigger? When do you have enough knowledge? And there's never going to be a definitive line in the sand to say, okay, I'm ready to do it per se. But here's what I would recommend to you. You're a small business owner. Okay.
Yeah.
You want to keep growing and scaling your business. That should be your primary focus. So if I'm you, I don't want to do anything that's going to distract me or take my attention away from my primary bread.
Exactly.
So what I would do if I was you is go find somebody who does this, is competent in doing it, that I know, like, and trust, and partner with them, whether it's in real estate or investments. Even if you're going to go find a financial advisor, okay?
Yeah.
It needs to be their full-time job, number one. Can't be a side gig. Yeah. They have to have a decent track record, a pretty good track record, and the stuff that they're the stuff that they're asking you to invest in, they better be investing in as well. Otherwise, what are you doing there? So for you, what I say, if you say, okay, I want to get into real estate, okay, because it's popular right now, and I like the different ideas behind it, I would find somebody like us, and I would spread out my investments. Say I had $100,000. I'd spread out my investment 50 and 50 in two different offerings that we have. Now, the reason I would do that is it's not going to overwhelm your bandwidth. You do due diligence once. You talk to us as many times as you want. We're managing the property day in, day out. We're talking to the banks. I'm the one signing on the debt, not you. So the most you could lose is the money that you put down. And you're getting access to an apartment complex operated by a professional versus I got to go find a single family house. Then I've got somebody calling me at 9:00 at night with the toilets going bad. And I'm into real estate because everybody's telling me I should be into real estate. And Steve's like, we only like real estate because it's a simple business, not necessarily because we like real estate.
Right.
You follow
that makes sense. That makes 100% sense. I don't want another job.
Right.
I want another cash stream.
You want more cash flow. And so we're really long-term investors. We're trying to hold these properties as long as it makes sense. And then you can pass it on. Say you get to being 60 years old and I keel over dead. This company's still here. You keel over dead. You have kids. You can still pass this cash flow on to your kids, and your kids don't have to know anything about real estate.
Yeah.
You don't have to worry about them operating it because it's literally handled by a company that is professionals at operating it.
Right. No, I mean, that's exactly what I would be looking for. And I think any small business owner would say the same because listen, as a small business owner, you know this, it takes so much time, so much capacity. And if you have a family, you have to preserve a piece of you for when you get back home. And the last thing I need, unless I'm going to sleep on the couch every night, is to have a call from a tenant at 6, 7, 8, 9 p.m. every day saying, toilet's running or whatever. Now, for somebody who said, say I've got 100 grand and I'm going to say, okay, I'm calling you, I'm calling Steven and I'm saying, listen, I have 2 rounds of $50,000 investments that I would love to bring to you. Obviously you find the asset, you kind of walk through this process. What can somebody expect to make the cash flow on a $50,000 investment? Or does that kind of just depend on timing and they're finding the right good asset?
So I would say every deal is going to be a little bit different. So it's not the same straight across the board, but basically where we're investing in is tertiary markets. We're in mid-market complexes. So that's 40 to 100, 110 units. And that provides us a pretty good opportunity to be above the really fierce competition of everybody trying to buy a house or a small apartment complex, and below the Blackstones of the world who have more money than everybody else, and they don't care if they make money on an investment. So the return profile that you should expect with us is we're trying to compound money at a minimum of 15% per year. In terms of cash flow, probably in year one, you can expect a 3 to 5% cash on cash return, somewhere in there. And then over the life of the investment, before we do any refinancing or anything like that, typically we're going to see a 10% cash on cash return net of fee average. Now, if we don't refinance in year 5, which is typically our goal, is to start doing refinances in year 5 to pull money back out to give you capital to do whatever you want with, then those cash flows like in year 10 can be 17, 18, 25%. I mean, it's really hard to say what rents and expenses are going to be 10 years from now, but
that's true. Okay. So essentially, at 3 to 5% to cash value, essentially could be anywhere between like 1 and 300 a month or 1,500 to $5,000 a year, something like that, right?
Something like that. Yep. In year one.
Year one, right. And then obviously
year 2 is probably going to be 7, 8%, and then keep creeping up after that.
Amazing. So, and at that point in time, my money back is increasing and I'm not doing anything. I'm just checking in with you, kind of seeing how things are going, essentially.
Yep. Once a quarter, you're going to get a check from us. You're going to get communication every month. You're going to get a check from us once a quarter, and somebody else is paying your debt for you when it gets 0 degrees outside and the pipes freeze or something like that because somebody forgot to leave their heat on. Somebody else is taking care of that for you. The value of your property is getting pushed. Sometimes we'll have calls with owners. They're older individuals. They have a smaller apartment complex, and we'll look at their rent roll and we're like, you realize how much money you're leaving on the table because you're not like, I don't know, pushing rents the way you should.
Yeah. And these are guys that are just sitting on these properties. Probably they're just kind of passively taking them. You're finding those guys and saying, hey, this is an opportunity. Let me take this off your hand. You're well into retirement. Is that typically how it goes?
So, sometimes quite a few times we try to do that, and we try to do it in a way that's beneficial to everybody. It's beneficial to us, and then it's beneficial to them as well. And then the benefit. So say you take somebody who has a property like that. They have a 50-unit apartment complex. They have it paid off in cash. It's been paid off in cash for a long period of time. They haven't pushed rents. Why would it be better if they could rewind 30 years and invest with us in that same asset than owning it 100% themselves? Because our job literally is to talk to the bankers every single day to know what the risk profile looks like. And so how many more times over those 30 years would have we restructured the debt and given you cash that you could go and invest in other properties? Instead of having 50 units, you could probably have the equivalent of 100 or 200 units with the same cash flow profile paying you off or paying you. So
interesting.
It's just optimizing your investment because you're paying somebody to do the due diligence and you're still making a really good return.
Right. And over time, like for example, like when you're talking about refinancing all these things, is somebody involved in those, in that kind of stuff? Or is it kind of like, hey, you guys are doing the due diligence, you guys are going to the bank, you're refinancing at the right time, doing the cash outs at the right time? Like, is that something you guys handle, exclusively?
Yeah. So yeah, we handle everything exclusively. We would be the ones that are doing the personal guarantees, not you as the investor, but we do notify you and let everybody know ahead of time. Right. So like, if everybody's like, we don't want to do that, you could tell us and we'd be like, okay, we'll have a conversation about it. But if you really don't want to do it, okay, we won't. But
yeah. No, that makes sense. So, it's no, go ahead.
So we try to let everybody know what's going on as much as possible. And sometimes maybe we over communicate, but I'd rather have you know what's going on. Yeah,
exactly. All that said, one of the things that has always been the run up for me is like, how much of my cash reserve should I invest? So, let's say, easy math, we have 150,000 and that's just stacked away, that's emergency fund. That's just home savings, as well as, an investment savings, not including any sort of like equity in a home or anything like that. Which is, I guess, a secondary question. One, when do you know to break a chunk off of that? And I know it's probably subjective, but when do you know to break a chunk off and how much? And then the other thing is it wise for somebody to take, like, we've got 50 to 60,000 of equity in our home right now. It's like, would it be wise to pull that out and invest that? Although then we have another payment, you know what I'm saying? So, or should we just do that with cash? You know what I'm saying? So essentially, when do we break it off? How much? And is pulling out home equity to then roll into real estate a smart or not a smart idea?
Okay. Great questions. Let's take the home equity. Should I take my money? Should I take equity out of my house today? In today's day and age, in today's environment, I'd say no. The reason I say no is the interest rates are pretty high, 7-8%, right? And it's your primary residence, right? Or say it's your primary residence.
Yeah.
You should probably be pretty protective of your primary residence, and I would not do a HELOC. I don't like any of that stuff. Floating or lines of credit. I don't like that stuff. Not out of your house, unless maybe it's your own business that you're investing in, but you have 100% control over it at that point. Now let's go to say you have 150,000 in cash, and that includes your safety reserves and stuff like that. First, what is your monthly cash burn? If you were to go to zero income, how much do you need to survive on every month in a reasonable amount? Figure that out and then base it on that. Okay. I would want to have at least 4, if not 6 months. Okay. Of that cash burn. So I can't really give you an exact number, but say out of 150,000, you want to keep $50,000 to $60,000 of cash on hand, invest the rest. And then if I was going to go straight heavy into private investments, which is what we do, the real estate thing, I'd take 50 and 50 or have a conversation to see if we would be willing to split that, because typically our minimum is 50. But if somebody's coming to us with $80,000 or $90,000, they want to put it in 2 different investments, we'd be willing to have a conversation.
Yeah. Okay. So that makes sense. So essentially, what I hear you saying is kind of the standard common sense perspective. You're not draining your emergency fund. We have 6 months put away. We also have some more in the regular savings, and then we have some more in, obviously, an investment account as well. Now that investment savings is one of the things that we have not prioritized up until the past couple of years, simply because we didn't know what we were looking to save to. It's really hard to save for something that you don't know what you're saving for. And so, we've done the Roth IRAs, we've done some stocks here and there. Obviously, I've been super interested in just playing with some day trading kind of stuff. Not full-time, obviously, not actually day trading, but just kind of playing some stocks here and there. But at the same time, all of these things take time. Buying another business takes time. Even investing into my own business, which I do regularly, takes more time, right? Now, the investments into my own business, you can leverage money for time. So now I'm getting more time back into my day because I've reinvested back into the business. So Holy Hill Media is a separate thing. But now I'm at this place where it's like, I want to make my money move,
Mm-hmm.
I don't want to move with my money. I don't want to have to move with my money. Now, would you say that almost like, I mean, confidently saying real estate's the best way to do that? Now, again, the position is like, okay, yeah. Tell me where you're coming from with that.
Okay. So your highest return on investment is going to be your business, typically.
Yeah.
Okay. And speaking of you specifically, your best investment is your business. Now, if you don't want to have to do as much day-to-day stuff or working in the business as much as working on the business, then you're going to have to expend, yes, cash and also a lot of energy for a short period of time where you scale up and you build systems and positions of other people to do that type of organization thing. That takes you from being a small business owner or worker to like actually owning the business.
Yeah.
And that way you can still direct things without having to actually go take photos and do Instagram posts and all that type of stuff. It makes it a lot easier on you because your business can run even without you being there. That's the way you own a business versus you are basically self-employed is, would my business run without me for 4 months? If it will, you own a business. If not, you're still self-employed.
Your job, that's a job, right? Yeah.
That's your best investment first and foremostly. Now, if you want to de-risk, I mean, I think we had this conversation before. I'd say 70-30, right? 70% or 80%, somewhere in there, invested into your business, 20 to 30% invested into some other thing. If it's real estate, that's fine. But I don't want my attention to get sucked away from that. From my business,
Exactly. So I have one more question about this concept of leverage. And I've asked you a couple of questions about this, and I'm still kind of really trying to grasp what it is and how to use leverage. Obviously, leverage, from my understanding, is borrowing money that is of greater value for the asset that you're sinking that money into. Now, my question is, how do you know, like, if I have, simple math, 50,000, we're talking about these increments of 50,000. If I have 50,000, how much leverage does that give you? And like, how, as far as equity is concerned, as far as the loans concerned, as far as all these things concerned, how do you know how to get the most leverage out of my 50,000? Like, what's the conversation around that to maximize leverage around my cash?
Yeah. So I'd say asset first, leverage second. So asset first, meaning your first question is, what is the quality of the asset that I'm buying, right? I'm okay with a little less leverage if I can get a lot better asset, right? And so sometimes when you're getting a lot better assets, you have to take a lot less leverage because the cash flow profile to pay the debt doesn't look as good.
Okay.
Generally, though, you're going to get a 3-to-1 or 4-to-1 return, meaning if you have $50,000, when it comes to real estate, specifically multifamily, you're going to be able to buy $150,000 to $200,000 worth of real estate. So when somebody comes and invests with us, typically it's going to be 3-to-1 leverage or 3.5-to-1 leverage. Because we're not trying to get too crazy on stuff. Managing risk. Honestly. Yeah. So
how many people are typically going in on something like this? Because obviously you have multiple investors. Like if I say 50,000 here, am I just partnering with Rust Belt, or am I partnering with Rust Belt and another investor? How does that work?
So when you invest in a deal that we're doing, you are an owner of real property, real estate. Okay. So that's different than investing in a real estate investment trust, like what you can get on the stock market or stuff like that. And so you are an owner of this property. There's a whole operating agreement of how this property is going to run. And the way the operating agreement's written up is, you're partnering with somebody else who's bringing cash technically. However, neither one of you have control over day-to-day operations or can mess up the other's investment, right? Gotcha. The management aspect comes to Rust Belt Capital. And yes, we're putting money in as well. Nate puts money in, I put money in, the house puts money in. So we have skin in the game. Yeah.
That's what I would want, hopefully, if I'm doing something like that. It gives me peace of mind knowing that you have vested interest too. No, that makes sense, man. It's been helpful, man. I feel like I have more questions than answers around this kind of stuff, and trying to figure out, how to make my primary and initial asset business in Holy Hill Media to create generational wealth. And I know that, the average millionaire, they own real estate. It's like 77%, right? And so to get to that place, I think that just trying to figure out how to become familiar with not only the options, but just the process of leveraging capital for equity and recurring cash flow. It's a deep conversation, man. You got me on the investor's guide, and I think that's a tough read. I'm in there, man. I'm in there.
There you go.